Dear Madam everyone, we are pleased to present our financial analysis of Spritzer. In this presentation, we will evaluate the company's financial strength and justify whether the Spritzer has the capacity to take additional loan capital. This analysis is prepared by our group member as listed on the slide. Spritzer has been listed on Bursa Malaysia since 2022. And as early of 2026, the company market capitalization of approximately 1.7 billion ringgit Malaysia. This is to reflect long-term stability and strong investor confidence. The group is the market largest bottled water producer, holding approximately 40% of the domestic market share. It's a strong brand portfolio, including Spritzer mineral water, Spritzer sparkling, and things. This is to support consistent revenue generations. However, Spritzer operates a fully integrated business model covering water extractions, PET bottle manufacturing, and nationwide distribution. The group main operations are located in Taipei, Perak, with export to Singapore, Brunei, and China. In addition, Spritzer places a strong emphasis on the environment, social, and government ESG practices include the use of the recycled PET bottle and sustainable forest management, supporting sustainable long-term growth.
Moving on to interest cover, which measures the group's ability to meet its interest obligations from operating profits. In 2022, the interest cover stood at 52.68 times, declining to 40.87 times in 2023 and 31.74 times in 2024. Although there is a downward trend, the interest remains exceptionally high. This means the group generates more than sufficient earnings to cover interest expenses, indicating a very low default.
Now we are moving on to the interest priority percentage. Interest priority percentage show how much of a company's profit is used to pay interest on its debt. So, the lower the percentage, the less pressure interest payment placed on the company's earning, and the more profit is available for growth. So, this table shows the interest cover and interest priority percentage from 2022 to 2024. In 2022, the interest cover was 52.68 times, resulting a low interest priority percentage of 0% to 1.90%, indicating strong ability to meet interest payment. In 2023, the interest cover decreased to 40.87 times, and the interest priority range increased slightly to 0% to 2.45%. By 2024, the interest cover further declined to 31.74 times, with interest priority percentage rising to 0% to 3.15%. Overall, although interest priority percentage have increased over time, they remain relatively low, showing that interest payment place minimum pressure on profits.
Now, let's take a look at asset cover, which reflect the level of protection available to lenders. As you can see, in 2022, asset cover was extremely strong at 32.05 times. However, it declined to 12.32 times in 2023 due to higher borrowings. And it improved slightly to 13.12 times in 2024. Next, we consider the asset priority percentage, which measure the proportions of the group's tangible asset that will be required to repay loan capital in the event of liquidations. In 2022, the asset priority percentage ranged from 0% to 3.12%, indicating a very strong asset protection. In 2023, this increased to a range of 0% to 8.12%, mainly due to an increase in loan capital during the year. In 2024, the asset priority percentage improved slightly to a range of 0% to 7.62%, reflecting a better asset coverage relative to borrowings. Although asset priority percentage are higher than in 2022, but they still remain at manageable level.
We explain the gearing position of Spritzer Bright. This slide shows the gearing ratio from 2022 to 2024. Based on the table shown, Spritzer gearing ratio increased from 3.16% in 2022 to 8.3% in 2023, before decreasing slightly to 7.71% to 2024. Lower gearing ratio in 2022 indicate that the company relied heavily on the equity financing and which minimal depends on the borrowing. Although the gearing ratio remained low overall due to the continued expansion of a total equity, the significant increase in 2023 reflect that the company higher level of borrowing during that year. In 2024, the modest decrease in the gearing ratio suggests an improvement in the debt-to-equity balance, supported by the stronger equity growth relative to the borrowing. Importantly, despite the increase in gearing in 2023, the ratio remained well below the 40%. This Spritzer Bright continued to maintain a healthy and a conservative capital structure, with a low reliance on the debt financing.
Firstly, the group's debt servicing capacity remains strong. Based on our interest cover analysis, Spritzer consistently generates operating profit that are more sufficient to meet its interest obligation. Although interest cover has declined from 2022 to 2024, it remains at a very high level of over 30 times. This indicates a low risk of default and confirms that the group can comfortably service additional debt. Secondly, the interest burden on earnings is minimal. This is supported by interest priority percentage, which remain below 3.2% across all 3 years. This means only a small portion of earnings is absorbed by interest payments, ensuring that the profitability is largely unaffected. Therefore, additional loan capital is unlikely to place significant pressure on the group's earnings.
Next, Spritzer continued to maintain strong asset cover. The group's tangible assets significantly exceed its existing loan capital, providing a strong protection for lenders. Even in 2024, asset cover remains above 13 times, which reflects a solid asset backing. This is actually supports the group's ability to raise additional secured borrowing while maintaining lender confidence. Finally, the gearing analysis shows that Spritzer remains undergeared, with gearing below 10% throughout the period. This indicates a low reliance on debt financing and highlights significant capacity to increase loan capital without materially increasing financial risk.
In conclusion, Spritzer Bright is in very strong financial position. From our analysis of interest cover, asset cover, and gearing, we can see that the company is financially stable and exposed to relatively low risk. In terms of loan capital, the risks remain manageable. Interest payment only take a small portion of earning, and the group's strong asset base continues to protect creditors. The company's low gearing also showed that Spritzer has clear capacity to take on more loan capital. In other words, the group can raise additional financing without significantly weakening its capital structure. So, we recommend that the board proceed with issuing secure redeemable loan stock in a careful and controlled manner. This will support future growth while maintaining financial stability. That's all from us. Thank you.